All right, let me ask you a question. If you suddenly had an extra chunk of money each month, maybe a bonus, a raise, or you just tightened up your budget, would you put that money into investing? Or would you throw it straight at your home loan? This is one of the most common money questions people ask, and honestly, it's also one of the most confusing. Because depending on who you listen to, you'll hear two completely opposite answers. One side says, pay off your mortgage as fast as possible, be debt free, sleep better at night. The other side says, why would you rush to pay off cheap debt when you could invest and grow your wealth faster? So, which one is actually right? Well, the real answer is it depends. And in this video, we're going to talk through how to think about this decision, not just what sounds good on paper. Now, before we dive in, quick disclaimer, this isn't personal financial advice. I don't know your full situation. What I can do is help you understand the trade-offs, the math, and this part is important, the emotional side of the decision, because money decisions are rarely just about numbers. They're about stress, freedom, risk tolerance, and how you want your life to feel. So let's start with the most straightforward option, paying off your home loan. There's something incredibly powerful about owning your home outright. No bank, no monthly repayments, no interest ticking away in the background. When you pay extra on your mortgage, you're getting a guaranteed return. If your home loan interest rate is, say, 6%, every extra dollar you put in is effectively earning you 6%, risk-free, tax-free. And that risk-free part matters. Because unlike investing, there's no volatility. The market can't crash your mortgage payoff. You're not waking up to headlines wondering if your home loan just lost 20% overnight. There's also a massive psychological benefit. For a lot of people, having a mortgage hanging over their head feels heavy. It's this constant obligation, so when you aggressively pay it down, you feel lighter, more secure, more in control, and here's something people don't talk about enough. Once your mortgage is gone, your required income drops dramatically. You need less money to survive. That gives you options. You might take a lower-paying job you enjoy more. You might work part-time. You might start a business. That freedom is real, but there's always a but. Paying off your home loan isn't perfect. The biggest downside is opportunity cost. Money you put into your home is money you can't easily access again. Yes, there are redraws and equity loans, but they're not the same as having cash or investments you can sell. And historically, long-term investing, especially in things like diversified stock markets, has returned more than typical mortgage interest rates. So if your mortgage is 6%, but your investments could earn, say, 8 or 9% over the long run, then mathematically investing wins. Another thing to consider is inflation. Over time, inflation makes debt cheaper. Your mortgage stays the same in dollar terms, but your income generally rises. That means future repayments feel easier than today's repayments. So by aggressively paying off your loan early, you might be paying back money that's actually becoming cheaper over time. Which brings us to the other side of the debate, investing. Investing is how people typically build wealth. When you invest, whether it's shares, index funds, or even investment property, you're putting your money to work so it can grow without your direct effort. Over long periods, markets have trended upward. Not smoothly, not predictably, but upward. So if you're investing consistently while your mortgage slowly ticks down in the background, you're essentially running two engines at once. One engine reducing debt, one engine building assets. And that combination can be incredibly powerful. There's also liquidity. Investments are usually easier to access than home equity. If life throws you a curveball, job loss, medical issue, you can sell investments far more easily than you can sell part of your house. But, and this is important, investing comes with risk. Markets go down, sometimes for years. And if you're the kind of person who panics during downturns, investing while carrying a large mortgage can feel unbearable. Imagine this scenario, you still owe hundreds of thousands on your home, the market drops 30% and your investments are down. Your job suddenly feels less secure. That's when theory meets reality. Not everyone can emotionally handle that kind of volatility, and pretending otherwise can lead to very bad decisions, like selling at the worst possible time. This is the part most people skip, but it might be the most important. What matters more than the perfect strategy is the one you can actually stick to. If paying down your mortgage helps you sleep at night, reduces stress, and keeps you motivated, then that has value beyond the numbers. On the other hand, if investing excites you, keeps you engaged, and helps you stay disciplined long-term, that also has value. I've seen people chase higher returns through investing, only to panic and sell during a downturn and end up worse off than if they'd just paid down their loan. And I've also seen people become so focused on killing their mortgage that they reach their 50s with no investments, no liquidity, and no growth assets. Neither extreme is ideal. For most people, the answer isn't either or. It's both. You might pay extra on your mortgage to reduce risk and stress, while also investing regularly to build long-term wealth. This way, you're hedging your bets. You're not all in on one strategy. You're balancing security with growth. If you found this helpful, hit the like button. It really helps the channel. And let me know in the comments. Are you team mortgage payoff, team investing, or somewhere in between?